Welcome to the Lend Academy podcast, episode number 80. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to welcome Andrew Graham. He is the CEO and co-founder at Borrowell. They are a marketplace lending platform based in Toronto, Canada. Yes, they are north of the border here, and they've been around for a couple of years. Wanted to get Andrew on the show to talk a little bit about his company, talk about some of the unique things about the Canadian market, some of the unique approaches they are taking, particularly when it comes to borrower acquisition. And also we delve into some depth about a recent partnership they announced with a large Canadian bank. Hope you enjoy the show. Welcome to the podcast, Andrew.
Pleasure. Good to be here.
So just let's get started with giving the listeners a little bit of background about yourself and what you did before you started Borrowell.
Sure. I worked for a Canadian bank running the insurance division, and I did that for a number of years and saw how profitable the credit card division was. Every quarter, we'd work as hard as we could in insurance and be soundly beaten when it came to profitability by the credit card division. So that was sort of what gave me an insight that there was something interesting going on in unsecured consumer credit here in Canada, like there has been in many other parts of the world.
Mm-hmm. Okay, so was that the impetus for starting Borrowell? I mean, what was the trigger that got you over the edge and decided you wanted to found a new company?
Well, Canada is an interesting market in a number of ways. We have a very concentrated banking system. The top 6 banks in Canada control close to 90% of assets, much more concentrated than the U.S., for example. Mm-hmm. And, as I was sitting in my job, sort of looking out on the industry and seeing how profitable credit card businesses were in this system, and then going to lend it in the early days and looking at how the online lending industry was evolving in other markets, it really struck me as sort of strange that there wasn't any activity really in online lending in Canada at a time when it was growing by leaps and bounds in other markets. And as mentioned, the Canadian banking industry is very concentrated, and there's a bunch of dynamics that make it an even more attractive market for unsecured consumer credit. Interest rates on credit cards are almost universally in Canada, 19.9% or higher. I've read one study that sort of said, interest rates on credit cards are about 400 basis points higher on average than in the U.S. And yet default rates across the cycle and across almost any part of the credit spectrum have been lower traditionally in Canada, including in 2008. Losses were lower on average across portfolios here than the U.S. So there's some fundamental dynamics that make Canada, we think, a very attractive market for this kind of product. And it was striking that there was no one doing this when I and my co-founder sort of first started looking at this in 2012, 2013.
Mm-hmm. So can you just tell us a little bit about the Canadian system? Like let's talk about the banking. You talked about the six big banks, but do these banks all offer personal loan products, or did they offer and they stopped? I mean, how does the banking system? What's it like in Canada?
So we have a very stable banking system. We had no significant or really no banks of any kind go bust during the financial crisis. But the corollary of that is that it's a very profitable banking system. So a statistic we like to use a lot is if you lined up all the world's banking systems by aggregate profitability, so not on a per capita basis, but just by aggregate profitability, Canada comes fourth. So there's more banking profit generated in Canada than in the UK, for example, or in Germany. I mean, countries that you think of as being, very well developed when it comes to banking. Canada's, there's a lot more profit generated, about 2x on a per capita basis, what banking profit is in the US. So we have a very stable, but fundamentally very expensive banking system here in Canada. Certain kinds of products are readily available. For example, lines of credit are increasingly available, whereas banks have really de-emphasized personal loans at the expense of lines. And lines are much easier to get if you have an asset to secure them against, like a house. So getting an unsecured line is a challenge, especially if you don't have a relationship with the bank previously. I mean, it involves many visits to the branch, et cetera, typically. So when we were looking at the market, it was not common to get a loan, first of all, and certainly it was not possible to do it online.
Right. So then did the financial crisis impact what banks were offering. Like we know in the US, banks that had a personal loan, offering for the most part, they removed those from from their offerings, and in small business they tightened it dramatically as well because of the crisis. Did the same thing happen in Canada?
Yeah, I'm not sure if the pullback was quite as stark. I think there just wasn't the same availability even before the crisis of personal loans. So the pullback may not have been as stark, but we've sort of ended up in a similar place.
Right. Okay. So let's just talk about Borrowell for a bit. Tell us a bit about your company. What kind of loans you do? What's some of the terms of the loans? What do you offer?
So we're focused on prime consumers, meaning people with credit scores above 660. And we offer, I would say, sort of the fairly standard prime consumer loan product, which is a personal loan with 3-year terms and 5-year terms. We do between $1,000 and $35,000, and our rates range from about 5.5 up into the mid-20s.
Okay, so that's pretty similar to what many of the US platforms offer. So then, as far as the borrowers themselves, who do you said you're prime consumers, but what are they using it for? What is it? Debt consolidation primarily off credit cards? I mean, what are the kinds of borrowers that you're attracting?
Yeah, I mean, debt consolidation certainly is a large share of our origination volume because we've certainly been active targeting those consumers. We skew higher than many other platforms in the prime space in other markets. So our average FICO across our portfolio, and it's roughly equivalent to sort of like what a U.S. FICO would be, is about 740. So that's quite a high sort of average FICO. So we've been able to attract, I think, a very high quality group of borrowers. And average loan size for us is about $12,000-$13,000.
Mm-hmm. Okay. And so then how are you finding these borrowers? Are you finding these people online? Are you doing a lot of direct mail? How do you attract them?
It's really been through a combination of different channels. We started out, I think, more focused on online channels, and we've had a particularly strong relationship with Facebook. They've been very helpful and supportive of what we're doing. I think the channel, though, that we're most excited about is a proprietary channel that we launched back in June. Before we came along, there was nobody in Canada offering credit scores for free. It just wasn't a thing here, or certainly no one offering them on a mass basis. So we became the first company to do that. We partnered with Equifax back in June, and we now offer credit scores for free. And we've had tremendous response to that in just the sort of 4 months since launching. We've had about 130,000 people now sign up for that program. So a really, really good response. I think there was sort of a pent-up demand. And that gives us an opportunity to advertise our loan product to people who are appropriate for it. And so that's become a very important channel for us, and one that we're excited about. I mean, it also in some ways eliminates the challenge that comes from targeting people who are actively searching for loans. I mean, that channel allows us to avoid that by targeting people that are there to get better education about their credit score. And I think we know that a big lesson from certainly the U.S. experience is that channel matters a lot when it comes to assessing credit quality.
Mm-hmm, for sure. Yeah, I mean, a Google AdWords person is very, very different from someone like let's say from who's coming from like Credit Karma or even a direct mail piece where a lot of that their what their credit score is and what kind of borrower they are. So it's fascinating that Canada didn't have that because it's been around in the US for many, many years. But it's curious to me because there's so many parallels between Canada and Australia that, we have this very similar banking system, extraordinarily profitable. And, there's the leading company in Australia has also gone and created a free credit score system. Society One, they did that. But so you've got this proprietary channel. That's fantastic. And so let's just talk about the underwriting piece. So firstly, actually, let's just maybe before I go there, when you're giving people their free credit score and you've partnered with Equifax, that means you must be getting a pretty, you have a very solid credit picture of all those 130,000 people that have signed up for that. Was that fair to say?
Yeah, absolutely. It's a way for us to get to know customers better, and not only, of course, at a point in time, but over time. So we're very excited to use ongoing credit data rather than just point-in-time credit data to feed into our pricing models and so forth. So we think there's actually a lot of synergy when you combine the model of sort of credit monitoring and lending. I mean, we think there's some natural synergy there.
Mm-hmm. For sure. And I think that they're going to be a higher quality borrower too. If someone is really interested in monitoring their credit, they're going to be less likely to not pay their bill because they care about their credit, clearly. So let's just talk about underwriting for a little bit. Tell us how you've built your underwriting model and how you're refining it, what your approach is.
Yeah, I would say we have a sort of a two-part process. We, first of all, have a number of tools that help us assess fraud risk. As I'm sure many of your listeners, know and can relate with, fraud in the online channel is always a risk and something that we have to be very careful with. So we have a series of tools we use to assess fraud risk. And that's a part of our business where we've done a lot of development in the past couple of years, and we're really excited about where we've landed. Though of course the war is never over. There's always very smart people on the other side trying to figure out ways to defraud you. So that's a fight that's never finally won.
Of course.
And then a totally separate decision for us is then the credit decision. And we take, frankly, I think a more traditional approach to credit risk assessment. We think information from the file, much more than just score, but we think information from the file is really the best information there is for assessing the risk when it comes to our prime borrowers. We do supplement it somewhat with other factors, with other variables. As I mentioned, channel matters a lot, we believe, but fundamentally, we're not looking at the number of Facebook friends that you have when deciding what interest rate you get or whether you qualify for a loan. We leave the sort of more social exotic stuff for fraud and focus on really, I would say, traditional credit underwriting for pricing and for loan approvals.
So is this been developed by, do you have people who worked in the banks for, maybe for the credit card divisions or whatever that are really helping to create this? Or how have you gone about creating it?
Yeah, so one of my co-founders is a gentleman by the name of Scott Layton, and Scott worked at the bank where I was previously. He was chief risk officer there and managed a large credit card portfolio, multi-billion-dollar credit card portfolio through for a number of years, including through the financial crisis. So he was chief risk officer of a credit card portfolio through 2008, 2009, 2010. So really saw firsthand, what happens to unsecured, loan portfolios through crises like that. 25 plus years of banking experience. So a really, important person in the foundation of the company. And, so we believe it's sort of back to our approach of, we believe in fundamental understanding of credit and we believe there's in some ways no substitute for experience. Now, Scott works closely with our analytics team, which contains people who don't have 25 years of experience, but have a lot of experience with latest statistical techniques. And we think that's a great combination. I think when you can put, someone very, very experienced or a team of people very experienced together with folks who are very quantitatively adept, you come up with a great solution and a great approach to credit risk.
Mm-hmm. And so just on that, you've been operating for some time now. I mean, how has the defaults trending? I mean, what can you share about that?
Yeah, we've been lending for just under 2 years. So we like to joke that, it's too early to declare victory, but it wouldn't have been too early to blow ourselves up. And sure. I'm very happy to say that we haven't. Everything is so far trending within expectations, within the tolerances of our models. But again, we're cautious to sound any note of victory because it still is early, and we know that as these portfolios season, a lot of that seasoning sort of happens after 12 months. So we're cautiously optimistic, but keeping a very careful eye on things.
Right. Okay. Well, let's switch onto the other side of the equation here and talk about the funding of these loans. Who are some of the investors and what have you? And could you just tell us some of the people who are or organizations funding these loans?
Yeah, sure. We were proud to have gone to market in partnership with a large Canadian bank, a bank called Equitable Bank, which right from the beginning was a partner of ours. They were a participant in our first equity raise and were one of the first organizations putting funds on our platform to loan. And they've really been a perfect partner. They don't have a credit card portfolio themselves, so there's no conflict with with an unsecured portfolio there, but they have a ton of experience with credit underwriting. They focus largely in the mortgage space, but have a deep understanding of consumer credit risk, certainly in the Canadian context. And we're an important partner working with Scott, our chief risk officer, in building out our initial credit models and asking the hard questions and, sort of validating that they made sense according to certainly their deep experience. So they've been funding loans on our platform from the beginning and have really been a superb partner for us. We have another Canadian bank, a larger Canadian bank, not public yet which one that is, but we do have a Canadian bank on our platform, another one funding loans. And then we have a series of family offices and other sort of, high net worth individuals. The true sort of peer-to-peer model is still sort of challenging in Canada from a regulatory perspective. It may be somewhere we go eventually, but it's certainly not where we started. We wanted to make sure that this business was very, easy for, fit in squarely, I guess I should say, with sort of existing regulation.
Right. And so on that, I mean, do you still have the concept of accredited investors there where are you open? You've said you're family offices, but are you open to individual investors or is it all institutional, and who are you open for?
Yeah, I mean, at this point, we're focused on institutions, which we would include large family offices in that group. So we're not sort of publicly advertising in any sense for new loan capital investors. Because there aren't as many people doing this in Canada, I think we offer a fairly unique channel to the asset class, to unsecured consumer credit. And we've spent, a lot of time with organizations in Canada and also organizations in the U.S. and have actually had very good reception from a number of debt funders in the U.S. to what we're doing. I think for U.S. institutions, getting geographic diversity into Canada is attractive. So we've been really pleased with the interest that we've seen.
Mm-hmm. So did you have any fallout this year? Because we had a couple of capital markets pullback earlier this year. We had the Lending Club episode. Did you have any fallback in your business?
I mean, I don't think it made things easier in any sense.
Right.
But on the other hand, this is still a fairly nascent asset class in Canada. It's earlier, and there's still a lot of growth, I think, in interest. So that may have been tempered a little bit, but we're just at a very different stage, an earlier stage, in this market, and so there's still a lot of interest in it. So didn't help, but has not been fatal or hasn't stopped us onboarding new investors, for example.
Right. Sure. So then, and speaking of investors, what is the return expectations? I mean, across your platform, obviously you've got different risk grades going from just under 6 to over 20. I mean, what's the return expectations that you provide your investors?
We guide our investors to 7 to 8% after losses and after fees. We're currently doing better than that, but again, it's early, and we're not too early to sort of say that higher numbers and will be consistent. But that's what we're aiming to return our investors.
Mm-hmm. And then as fees, are you doing a similar sort of model? Do you have an origination fee and a servicing fee on the investor side, or how are you generating revenue?
Yeah, that's exactly right. We have an origination fee that gets charged to the borrower. We have a servicing fee for the investor, and then increasingly with our free credit score platform, we're experimenting with and believe that there's some long-term value that we can create for our members, showing third-party products. So the reality is there's a lot of people who don't need loans, but may well need a mortgage or may well need other kinds of credit products. And we think by presenting very targeted offers to them, we can create value, and that's something that we're focused on as well. So we're diversifying our sources of revenue, but remain sort of focused on providing consumers with the right credit solutions.
Mm-hmm. Interesting. So that's great, because you've got a major asset there with 130,000 plus. I'm sure you're getting many in every single day, many new people. And it's nice to be able to, I guess, monetize that beyond just the very small percentage that would want an unsecured personal loan, I guess. So anyway, I want to talk about this partnership that I read about recently. And I know we emailed back and forth about this a little bit, but I know that CIBC, one of the largest banks in Canada, and you've got them now as one of your partners. It seems like a bit of a coup from my perspective. So I guess, why don't you first explain who is CIBC and how did you end up getting on their radar?
Yeah, so CIBC is one of the 5 largest banks in Canada, and really, a very large bank in the North American context. They have about 11 million customers and are a significant player here, have been around for a very long time. And I think increasingly under the new CEO who took over there just relatively recently, have been increasingly focused on the power of digital and on the power of technology to better serve customers. And I think have been very sort of forward thinking about the value of partnership as a, in some instances, a faster and better way to get new ideas and new products to market. So, our partnership with them is very much in line with that. We're, out in market now with a really exciting product. It's a version of our 3 and 5 year term loans, co-branded. So this isn't a white label. This is a co-branded offering. And from the beginning, I think we were both really excited about that approach. We think it sends a great signal to the consumer. And so to wait for their customers to access 3 and 5 year term loans using the sort of easy online approach that we've built here. So leverages our technology and our processes and makes life, we think, better for their consumers.
So I got to ask you, okay, you're a 2-year-old company and you're doing business with a large publicly traded bank in Canada that has 11 million customers and clearly is a behemoth compared to you. How do you convince them that they need you?
Well, I'd really give their senior management a lot of credit for that. I mean, I think they ultimately decided that a partnership like this was in their best interest and something they wanted to pursue. And, right from the beginning have been, really determined to get it done and to get it done in a way that was effective and positive for both parties. And you're right. I mean, there are cultural differences between, a bank with 11 million customers and a 2-year-old platform like ours. But I think in the end, though it wasn't always easy, we've been able to get some of the best from both approaches. We've become a lot smarter about underwriting by spending a lot of time with their credit team, sort of showing them our approach and saying, this is how we do things. What do you think? And having them sort of challenge us. That's helped us. We've gone through all the sorts of tests and audits that you'd expect that we'd have to go through given the sort of the tight coupling. So, we've had so many different penetration tests of our IT system, a whole bunch of other kinds of audits on our controls. And these are things that I just don't think many, platforms at our early stage would do. But we think as painful as some of them have been, I think we're a stronger company for it.
Sure.
And I think, without sort of being immodest, I think maybe we've, I hope taught them a couple of things about, our approach to sort of development and being agile and moving quickly and iterating quickly to improve the consumer experience. So our belief is, and certainly from everything they've said, that it's been a positive so far for both sides.
So do they have a large credit card portfolio? I mean, I imagine they must have if they've got 11 million customers. Did they? And so answer that question and then say, and if so, then how are they getting around that fact with the cannibalization piece? Or do you think they really are such different products that it's not going to cannibalize?
Well, I can tell you they are very much a large credit card issuer in Canada, one of the largest. And I don't want to speak too much for them, but I can say that they, I think they recognize that the world is changing and financial services is changing, and cannibalization can be a risk for incumbents. But in some ways, there's a bigger risk for incumbents across many industries, and that's being behind change rather than in front of it. So I think they're taking a perspective better to be the lead and understanding what's going on versus not.
Right. So, and I presume this is just an offering they're making to their existing customers, or is this just if I went on to CIBC's website and I looked for personal loan, would I see this offering?
So we're taking a very sort of startup typical approach here in that we're starting with a limited base of customers and then rolling out to a larger group as appropriate. So it's not available today. If you went onto the website, you'd be eligible for this if you're part of a select group, essentially, of their customers today.
Okay. So did you create a special underwriting box just for CIBC that's really tailored to their needs, or did you iterate on your own underwriting model and it's using a standard model?
Without wanting to give too much away, I can tell you that there was great contribution from both sides. So it's not exactly the same product that we have. There's no origination fee, for example, but it certainly took input from both sides to build it, and we're excited about what we've built together.
So, is this, and this is purely just if there's no origination fee? I mean, I'm imagining, are they putting capital on your platform as well, or is this just purely a a software as a service type deal?
I mean, I think we both view it as a partnership. The fact that our brand is on it as well, I think, is an indication of that. So we view ourselves, I think, as much more than just a sort of a software vendor, for example. I mean, we view it as a partnership. When we speak to consumers, that, as part of this program, they see the co-branding. So, and the financial setup is I think supportive of that.
Okay, so then, I mean, are you looking for more deals like this? I mean, there's 5 other banks that are in Canada that obviously are, that you may have. It's not like America where there really are hundreds or thousands of banks, but hundreds of even mid-sized banks. I mean, is this something that you want to shop around to others, or is this something you're focused on just for this one entity?
I think it's early days for us with this partnership. We started life as a pure consumer play, and I think we're very excited about how that part of our business is growing, particularly with the free credit score offering, as well as with the growth and loan volume that we're seeing every month. So, we remain very excited about the opportunity to sort of be part of consumers' wallets here and eventually in other markets as well, perhaps. But we're also very excited about this partnership, and I think there's real synergies, back and forth. We're going to get smarter, faster on underwriting by working with CIBC, and we're going to be able to continue to evolve that product because of what we're doing in our direct channel as well. So, I think it's a bit early for us to say, how much of our focus shifts to partnerships. I think we're very excited about this partnership, and happy to talk again in 6 months or so and give you an update.
Sure. So then let's just look into. I mean, look forward to 2017. You've got this partnership in place. You've still got the rest of your business is growing steadily. What's next? Are you trying to just focus on your core business? Are you looking for new business lines? As you look to 2017, what are some of your goals?
So I think 2016 has really been about creating a platform for growth. So it's been about, proving out that our underwriting, so far is working well, knock on wood, with our sort of our core lending business, improving our understanding of channels for that business, lowering our cost of acquisition for that business. It's been about, launching a new channel in terms of free credit score. And then it's been about building this partnership with CIBC. And I think 2017 is about continuing to build on that base. We think there's absolutely room for additional product innovation in this market. We think there's absolutely opportunities in other markets, but we've got a lot on our plate right now. We've got three different initiatives that all intertwine and all support each other, but nevertheless all ones that we need to kind of continue to nurture and grow, and that's going to keep us busy through certainly the first part of 2017.
So we're not going to see you here in the US, except for maybe at a Lendit conference. We're not going to see you here in the US anytime soon then?
Well, never say never, but probably not in Q1 of 2017. Let's say that.
Okay. Well, on that note, I'll have to let you go. I really appreciate your time today, Andrew.
Well, it's my pleasure being on the podcast, certainly one I've listened to many times.
Great. Thanks. See ya.
Thanks. Bye-bye.
Canadian Imperial Bank of Commerce. That's what CIBC stands for. They are, as Andrew said, a large Canadian bank. They have a $29 billion market cap. They have over 40,000 employees, and they decided to partner with a fintech startup to really help them offer the loans online to their customers, because they realize it's not a core competency of them. And the way I look at it is this: lending is moving online. It's an unstoppable trend. Every bank will be impacted by this. If you're offering consumer loans, small business loans, even real estate eventually, you are going to have to offer an online product. And some of the more forward-thinking banks are making moves into this area right now, but we still have barely scratched the surface. I think 2017 is going to be the year of the bank partnership. I think we're going to see dozens of these kinds of relationships get established. And, I applaud Andrew and his team at Borrowell Borrowell for really taking the initiative here and really signing a deal with a very large bank north of the border. But we are going to see many more of these, I think, in the US in 2017. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.